The U.S. housing market is not a friendly place right now. There's really no way for me to spin it. There's three main barriers in front of most buyers that they have to navigate in order to successfully get themselves into a home. Home prices, interest rates, and availability issues that are brought on by low inventory. Interest rates just hit 8% yesterday, October 18th, 2023, and they're up nearly half a percentage point in just 2 weeks. Mortgage rates haven't been this high since 2000. Much of the reason behind these higher interest rates has to do with the Fed raising the federal funds target rate, which then in turn impacts other market rates by increasing the cost of credit throughout the U.S. economy. The Fed has been raising the rate at an attempt to tame inflation. And while inflation has been cooling down somewhat, U.S. economic indicators are still putting out strong numbers, which could indicate the Fed still has more work to do to bring the U.S. inflation index to its 2% target. The next Fed meeting is scheduled for November 1st, so we'll wait to find out what their next move is then. So what does this mean to you? What's the bottom line? Well, housing market experts are a bit mixed in their interpretation. Some are saying they think it is unlikely the Fed will continue to raise rates, but others are saying the Fed may keep rates higher for longer than expected. We're talking into next year. Most people agree that we are not going to see mortgage rates in those low threes ever again. Waiting for them to return? Well, that's dead end. It's not going to happen. Those super low mortgage rates were related to a black swan event, the pandemic. It threatened to bring the economy to a catastrophic halt. So what is going to happen with mortgage rates? Well, the truth is nobody really knows. It's a crystal ball question. Historically, rates have been closer to an average of 7% over the last 50 years. In doing research for this video, just 3 months ago, housing market experts were saying that they predicted rates would be at 6% by the end of this year. No one saw them jumping to 8%. I've said it many times, but it is impossible to time the market. Housing market data is always about 30 days old, just because of the amount of time it takes to get a transaction from start to finish, and then recorded and in the realm of public data. So you may be wondering, since interest rates are high, which is obviously going to wash some buyers out, does that mean that housing prices are coming down? No, not really. Even though the number of homes being sold is now at a 13-year low, the prices of homes being sold is still increasing year over year. The median price for existing homes, including single-family homes, townhomes, and condos, was at $394,300 nationally in September. If we sift that out to just single-family homes, the median price is $420,000. That's an increase of 2.8% over a year ago, and it includes all 4 regions of the U.S., Northeast, Midwest, South, and West. This is pretty astounding, especially considering many people were absolutely convinced the housing market was going to crash. Affordability of homes has been an issue for a while, but I think you're going to hear more and more about it because it's reaching crisis levels. When we talk about affordable in terms of housing, that means keeping somebody's housing expenses no more than 30% of their income. Buyers now need to earn nearly $115,000 a year in order to afford the average home. And that's a huge problem because it's $40,000 more than average earnings. This is a 15% jump over what they needed to earn last year, but wages are only up 5% in the last year, according to a Redfin analysis. In real numbers, the typical home buyer's mortgage payment is $2,866 a month. Looking back just a few years ago to 2020, the typical monthly mortgage payment was $1,581. The buyers who are being hit the hardest by this housing affordability crisis are first-time buyers because they don't have equity to move from one property into another, and they're unlikely to be at a point in their lives to be able to pay cash for a home. So what's a first-time home buyer to do? Well, consider some home types that might not be top shelf in your eyes. Condos, townhomes, duplexes, and zero lots generally offer a less expensive entry point. Many first-time buyers are also seeking funding from their parents to help offset the purchase price. The bank of mom and dad, you know? In fact, Redfin reports that nearly 40% of homebuyers under the age of 30 use family money to help purchase property in the form of a cash gift or inheritance. I mean, how can they not when the median sold price of an average home has increased 46% in the last 4 years? So, in what realm of reality are we living where home prices can stay so high despite the market being hammered by high interest rates? The key is inventory. U.S. housing inventory is at almost historic lows. There's a couple of reasons why. One being that home building has not kept up with demand for decades. The next being population numbers. Millennials are currently the largest generation and in prime home buying age. And Generation Z, the generation following millennials, is large and just now moving into home buying age, with the oldest people in that generation in their mid-20s. Additionally, boomers are living longer, healthier lives and are staying in their homes longer, which means less turnover of pre-existing homes. A new dynamic in the housing inventory conundrum is the locked-in phenomena. About 40% of current U.S. mortgages originated in 2020 and 2021, when mortgage rates were at record lows, and there were about 14 million mortgage refinances during that time, which means that there are an astronomical number of homeowners who are locked into rates in the upper 2s and mid 3s, and they are unwilling or unable to give that rate up. What do I mean by unable? Well, even though they may want to move for all the reasons that people normally move, like more bedrooms, different location, more space, the monthly payment on a similarly priced house would easily be $1,000 more a month than what they're currently paying, which means they're unlikely to be able to afford a better house. Nobody wants to pay more for less house. All of those moves that people normally do, the upsizing, the downsizing, the lateral moves to a different neighborhood, well, they're just not happening. With those three factors, a large pool of buyers needing homes, insufficient new build numbers, and regular people stuck in their existing homes, not making those normal moves, what we're seeing, national inventory is completely locked up. We thought inventory was bad last year, but now there's 14% fewer homes for sale this year. There was a really interesting article published by Fortune magazine recently that compared the current housing market situation not to what so many people remember from back in 2008, but rather throwing it back to the housing market of 1980. Listen to this. Take a look at this. According to Bank of America, today's housing market looks a lot more like the early 1980s than it does 2008. Back then, just like today, home prices had boomed for years before the Fed officials were ultimately forced to hike interest rates aggressively in an attempt to fight inflation. Sound familiar? The rise in the consumer price index peaked at around 14% in 1980, before then Fed Chair Paul Volcker's hawkish policies sent mortgage rates to 18% in a year's time, cooling inflation but sparking a recession. This caused a serious downturn in the housing market, in which home sales and building levels cratered. However, national home prices actually remained stable. At the start of Volcker's term as Fed chair in August of 1979, the median U.S. home sales price was $64,700, and even after nearly doubling mortgage rates, that figure rose to $69,400 by the second quarter of 1981. Over the past 18 months, the Fed's current chair, Jerome Powell, has been following a very similar game plan to Volcker's.
raising interest rates aggressively to quash inflation. The average 30-year fixed mortgage rate, the most common type of mortgage in the U.S., has soared from 3.8% in March of 2022 to over 7.5% today as a result. Actually, that's now 8% as of today. This, in turn, has slowed mortgage purchase applications and caused home sales to plummet, just as it did in the 1980s. But home prices, echoing the dynamic of that era, have yet to collapse. One of the key reasons for the resilience of the housing market in both of these periods is demographics. What have I been talking about? Notably, demographics were favorable back then, with baby boomers having entered the prime home buying age. Park and her team wrote Thursday, arguing millennials are in a similar position today. Some sales activity should be supported by millennials reaching their prime home buying age, and single-family building permits have steadily held up. This can help the housing market retain some of its momentum without falling apart. Bank of America economists believe that low inventory of existing homes for sale, combined with solid home sales to millennials, could help put a floor beneath prices. But that doesn't mean there won't be some near-term pain due to higher mortgage rates. With rates likely staying higher for longer, we are cautious of potential turbulence ahead, the group warned. Bank of America has previously forecast 0% home price growth and falling home sales for the full year of 2023, but it didn't offer a new prediction in its latest note. Eventually, as inflation fades, leaving the Fed to cut interest rates, housing affordability will improve. At that stage, we should see a more stable and healthy housing market, Park and her team wrote. Until then, hang tight. It may be a bumpy ride.
Tell me your thoughts on this analysis of the current housing market. Do you think that we'll see a crash like we did in 2008? Or will things shake out more like the 1980s? Leave a comment down below. Hey, it's been fun, and I'll catch you later.